901. Good morning, everybody. I'd like to welcome all of those who are joining us in person and virtually to the February 28th meeting of the Investment Advisory Committee. I'd like to welcome all of our IEC members who are here in person or by phone. If you'll stand and lead us in our pledge and join us in our pledge of allegiance and our salute to North Carolina flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the old North State love, loyalty, and faith. Thank you. I'll now ask the legal counsel to call the roll.
Good morning. This is Jason Sass, Deputy General Counsel to the Department of State Treasurer. First, I'd like to take roll call of the committee members to confirm we have a quorum, and then we'll go over a couple of reminders for our public meetings. For the roll call, Mr. John Annarella. Here. Mr. Lentz Brewer.
Here.
Mr. Loris Coakley.
Here.
Mr. Michael Mevin.
Here.
Mr. Greg Patterson.
Here. John, we miss you. You're the person not here.
I didn't get the memo. You were all coming.
Nora, you sound great from the ceiling. The speakers are loud.
And Treasurer Falwell.
Here.
And we have a quorum. Thank you, committee members, for your patience. Here are some quick reminders for our public meetings. For those who have called in, please remember to mute your phone when you are not speaking. State your name when making or seconding a motion. If you need to leave the meeting, please speak up to let us know. And if you rejoin, please identify yourself, though I think we'll know. Finally, for anything that this committee votes on, the votes will all be by roll call. We'll deem the members who make the motion and second it as voting yes. Today's meeting agenda is posted for public availability on the Department of State Treasurer's website at www.nctreasurer.com at the Investment Management Division page. If we lose the phone line connection altogether, the meeting will be in recess, and we will put a notice on the nctreasurer.com website homepage when we have information about a time to resume the meeting. Are there any questions about these procedures? Okay, thank you. At this time, I'll turn the meeting back over to the chair for approval of the last meeting's minutes.
Thank you very much. Do I hear a motion to approve the meeting minutes?
So moved.
Thank you. Of November 15th. Motion and second being made. Any further discussion? Hearing none, the clerk will call a roll.
Okay, for the roll call, Mr. Annarella.
Aye.
Mr. Brewer.
Aye.
Mr. Coakley.
Aye.
Mr. Mevin.
Aye.
And Treasurer Falwell.
Aye.
We have approval.
Thank you. We've already done the roll call. Before I call on Jeff and Chris, I want to say thank you to both of you and your staff for being such good stewards as I go across the state. People don't know who you are, they just know of your work. And I'd say if you have those two options, that's the best one to have. I also want to say for the audience, there will be a lot of people coming in and out today. We are in some of you know are in the public record that we're in a lawsuit where we're defending against Blue Cross Blue Shield, and that closing hearings are going on. So there'll be people coming in and out of our meeting as those hearings start and stop. So thank you all for your patience on that. Now we'll have our performance update presentation.
I'll hop right in. It's good to see everyone, and good morning, first of all. Just a quick thoughts on the fourth quarter of 23. Really, the market performance was really driven, I would say, mostly by the Fed reaction to some more encouraging inflation data that we got in November. We had year-over-year CPI falling to its lowest level in 2 years. And the Fed comments that went along with their final quarterly dot plot of the calendar year signaled the rate hiking cycle was over, cuts were around the corner, and that really was the fuel for a lot of the markets, especially on the equity side. median projections that we saw from the FOMC with those dot plots at the time pointed to 75 basis points in total cuts during the calendar year 24. However, the futures markets quickly got ahead of that, and futures markets really were showing market consensus of more than 75 next year ahead of that. I pulled up the numbers back to end the year, and the consensus there was at 100 basis points by the beginning of the summer of this year. 2 months later now from that period, we've unwound a lot of that. We're back to not even showing the first cut occurring until June if you look at futures, and really priced in now 75. So we've seen a fairly material change in that since the fourth quarter that we're really focused on today. On the back of that big quarter for public equity, S&P 500 into the year just pulled record highs from early 2022. Went on and hit that here to start this year. International equities are also strong for the quarter, but still trailed in the markets. On the commodity side, energy prices were weaker with oil and gas both moving lower, while precious metals saw gains in both gold and silver. Moving on to the bond market, on the backs of that data, it was actually the best quarter for bonds in over a decade as rates fell on the favorable inflation prints and the end of the hiking cycle on it. We saw, if you looked at kind of how we manage our investment grade on the longer duration core, it actually was the strongest quarter since we went total return in 97. So if you had duration on it, it's even a bigger number than just the last decades. Big changes there. We saw rates drop 75 basis points to 70 on pretty much most of the curve. The 5-year was a little more, but even the 30-year was down almost 70 at the end. In addition to the tightening we saw on the Treasury rate side, we also saw bond spreads move tighter to kind of add fuel to produce that big number. As we saw credit spreads moving for investment grade about an average 20 basis points in high yield, an average of 65. Saw the same pattern globally with central bank outlooks fueling positive returns, but not quite what we saw here domestically on the return side. So that's a quick look at the quarter. With that, I'll turn it over to Chris.
Good morning, everybody. Moving to slide 7. Excuse me if my voice goes in and out. Apparently allergies got me a little early this year. Bless you. That was good. Looking at slide 7, so the assets under management for the investment
Bond rally just ended.
Let's take a take. So AUM at the end of December for the total division was 181.2 billion. Right at all-time highs. We've been hovering around that for a little bit. The rally in Q4 certainly helped. So the total AUM was up about 8 billion for the quarter and up 16.3 billion for the calendar year. So pretty significant increases in our assets. The majority of that increase was due to the appreciation of NCRS, of the pension fund, as both public equities and fixed income markets rallied significantly as Q4, as Jeff just mentioned. NCRS was up about 6.9 billion for the quarter and 9.4 billion for the calendar year. The cash management program was down about 400 million for the quarter and up 4.4 billion for the year. The supplemental plan, which is the yellow sleeve there, that was up about 1.4 billion for the quarter and 2.2 billion for the year. And then the ancillary funds, which is the small gray sleeve there, was up about 170 million for the quarter and roughly 250 million. Moving on to slide 8, looking at our NCRS asset allocation as of the end of the year. The portfolio ended the quarter and ended the year at 118.7 billion, up from 111.8 billion at the end of Q3. The growth underweight decreased this quarter from about 5% to 4% as public equities had strong returns, returning more than 11%. Public equity is now close to neutral, our long-term target of 38%, while private equity, non-core real estate, and opportunistic fixed income continue to be underweight the long-term targets. Rates and liquidity continue to remain overweight, currently by just under 4%, with the majority of that overweight driven by the pension cash portfolio. Inflation sensitive and diversifiers is 1% underweight, with an underweight to inflation sensitive and a slight overweight to core real estate. And we continue to have a modest overweight of 1% to the multi-strategy portfolio. Moving on to the next slide, a more recent snapshot of the asset allocation. This is as of about a week ago. No major changes here. No intentional moves on our part. The portfolio is slightly less underweight growth and less overweight rates and liquidity, due mainly to market movements during the first 7 weeks or so of the year, as equity and fixed income markets have moved in opposite directions to start. Moving on to slide 10. Portfolio returns versus our two main benchmarks. So after having a rough October, struggling a bit, both equity and bond markets rallied extremely strongly in November and December to finish the quarter with 6.8% portfolio return. In fact, we had a November return for the total plan of over 5%, of 5.1%. That was only the third time since 2000 that the portfolio returned north of 5% for a 1 month time period. So extremely strong rally to end the year. And yeah, if you looked at our total plan performance through October, we were just north of 1%. So we had a 1% total return through October and ended the year at 10.2% return. So certainly nice to see. Certainly shaped how we're viewing the year as a whole with just the rally in the final 2 months of the year. As I mentioned, portfolio return 10.2% for the year, driven mainly by strong equity markets, which returned more than 22% for the calendar year. The 3 and 5 year time periods you can see here are at 2.7 and 6.7% respectively, with longer term time periods close to or above 6%. Relative performance for the quarter and the 1 year lagged both our benchmarks as equities drove performance. Longer term time periods are still close to or exceeding both of our benchmarks. And looking quickly at year to date, portfolio is up about 1%. As equity markets have continued to rally for the first 6 weeks, and we've seen bonds come back a little bit. Moving on to the next slide, if there's no questions there. Growth of a dollar chart. So we show this chart every quarter. Shows the growth of a dollar since the inception of our total plan return that we have in 1997. You can see that total pension, it's tough to see in the top right there, but the orange line, the total pension, is above both our benchmarks, slightly above the implementation benchmark for that time period, but pretty significantly above it for the long-term policy benchmark, which is what we look for. Moving on to the next slide, same charts, just showing different time periods for 5 years and for 10 years. And then we added in our total alternatives allocation as well to see how that fared versus our portfolio. You can see on the left, the 5 years ending, all 3 of those lines end pretty much at the same point, with the long-term policy benchmark actually slightly ahead of both the total pension and the total alternatives. But for the 10-year time period, you can see that's kind of the opposite. The total pension's ahead of the long-term policy benchmark, and you can see there that how much value add the alternatives allocation has added, being pretty significantly above both of those. Moving on to slide 13. So this is the contribution to total plan return for the 1 year ending December. This shows the contribution for both return and in earnings. So you can see on the right-hand side here, the 10.2% return of total pension equates to roughly 11.6 billion plan earnings for the year. And you can see which asset classes kind of affected that the most. So it's pretty clear here that public equity drove that performance, attributing about 75% of both the earnings and the return to public equities for the year. Moving on to the attribution charts on the next slide. Again, this breaks down the portfolio in terms of where the outperformance or underperformance came from versus our implementation benchmark. So you can see on the top left that The portfolio return 10.18% for the year versus the benchmark return of 10.79%, which is a negative value add of about 61 basis points. And then if you look at the top right, you can see the breakdown of that. The vast majority of the negative attribution there is due to the allocation effect, which is how we are positioned the portfolio versus our policy targets. The selection effect, which is how each asset class performs versus their individual benchmark, that was pretty close to neutral for the year. And then if you look on the bottom half of the chart, you can see kind of where those numbers come from. So in the allocation effect, the underweight that we had for the majority of the year to public equity detracted from performance by about 30 basis points, the overweight to cash by another 30 basis points, and then the underweight to private equity and non-core real estate added about 10 basis points to that. Now on the selection effect side, like I said, pretty neutral in aggregate, with public equities driving some pretty strong outperformance, and then non-core real estate and private equity underperforming their individual benchmarks for the 1 year. Moving on to the next slide, you can see the 3-year. Similar story, just not as much of a magnitude. The portfolio return of 2.7 versus the benchmark return of 3. That 30 basis point negative value add is kind of split between the allocation effect and the selection effect for that time period, with 20 basis points of allocation effect. Again, similar story in terms of where that's coming from. And then the selection effect was driven mainly by underperformance of the public equity for the 3-year time period. I know we've talked a little bit about that in previous public equity presentations. They had a strong year last year, and then as you see on the next slide, the 5-year, the public equity portfolio returned extremely strong for the long time period. So it was just this one time period where it shows pretty significant underperformance for public equity. So yeah, if we look quickly at the next slide, the 5-year, you can see what I'm talking about there. Benchmark return of 7.1 versus the portfolio return of 6.7, so negative value add of 40 basis points. And that was essentially all driven by the allocation effect with an 80 basis point underperformance there. But selection effect, which is the asset classes, how they perform versus their benchmark, was strong at 40 basis points. And you can see what I was pointing out with public equities, their selection effect there is positive for the 5-year, even though it was pretty significantly negative for the 3. So if there's no questions on any of that, I'll move on to the next slide.
Any questions?
This is our net of fees risk metrics here. Nothing significantly different to point out than what we've talked about in the past. I guess I'll just point out the rolling volatility on the top left. You can see that that's come down on the 1 year. Well, it's kind of been bouncing around a little bit on the 1 year, but you can see on the 3 and the 5 year, the orange and the gray line there, those are still significantly above the long-term average, which is the dotted line. And it's significantly above where we were, say 5-7 years ago, where it was well below that. So we continue to see in aggregate higher volatility in the markets. We've talked about that before, but we continue to see that. So it's certainly a different environment, a different world than we lived in throughout the 2010s, basically. And then you can see on the top right, the rolling tracking error. We are seeing that come down pretty significantly. You can see the 1 year is actually now trending below the average. And then the 3 year you can see is coming down as well. So a couple of reasons for this. One of the main ones is we changed our policy allocation to a couple of the asset classes when we did the asset liability study in 2022. So our allocation to equities is lower, so we're closer to our actual allocation to our target, and as well as the cash portfolios. You remember we lowered our public equity by 4% from 42 to 38%. We increased our cash target from 1 to 5. So now we're closer to our targets in general, and we've been moving in those directions anyways. So basically we're closer to our targets with a lot of the asset classes than we were previously, which will lead to lower tracking error as that goes forward. So we would expect that to continue to come down as we move closer to those targets. Moving on to the next slide. So this is the downside capture chart that we show every time. Nothing really new to point out here, just I guess the big pieces on the right there on the bottom chart, you can see kind of the drawdown chart. I guess the important point here is we haven't even made up for all of the drawdown that we saw in 2022. So you can see basically all of our benchmarks as well as the portfolio, we're still below where we were, at the end of 2021 and going into 2022. So 2022 was obviously a rough year. We've talked about that. Thankfully, we had a very good year last year, but we still haven't gotten back to basically zero from the drawdown back starting at the end of 21 and into 2022. So moving on to the universe comparisons on the next slide. So again, this is our comparison versus the BNY Mellon universe. They tracked U.S. public funds greater than 20 billion, around 14 or 15 peers that we have in here. This compares risk return, and then on the next slide, the Sharpe ratio, which is a comparison of the two versus those peers. So you can see for the 1 year, slightly below median at 60 percentile for returns, and then obviously lower than that through the longer term time periods. But then on the risk side, you can see similar story on the 1 year, similar risk profile, but then on the longer term time periods, you can see the very, very low risk profile, which we talk about a lot, much lower risk profile than most of our peers. Which is leading to kind of the lower return profile for the longer term. And then on the Sharpe ratio on the next slide, similar story. We typically fare better in this over the longer term time periods, given our higher allocation to fixed income. But we did see such volatility in fixed income in the last couple of years that really just kind of skewed some of these numbers, which we saw previously. So we'll see if that changes as rates stabilize, and hopefully we don't have the volatility in the bond markets that we have had recently. Moving on to slide 21. So this was the chart it was new last time. We talked about it a bit. We added some information here based on the conversation last time. So this chart shows the funded status of ourselves as well as all the U.S. public funds. And as we talked about last time, we haven't updated the data. We don't have new data. So the data is a couple of years old. It's as of 2020. But, NCRS is roughly 87% funded, which puts us in the 14th percentile of public plans. So the question came up last time around what the actuarial rate of return for these other plans are, because that helps drive pretty significantly what the funded status is, right? So we pulled that, and that's what the table is in the bottom right there. All of the states that have a higher funded ratio than us with their assumed rate of return. So the summary here is only one plan, South Dakota, has the same assumed rate of return as us. Everybody else has a higher assumed rate of return. So that would, if you have a higher assumed rate of return, you're going to have a higher funded status. That's just how the math works out. Again, we set the assumed rate of return what we feel is the most realistic for the plan going forward. So each plan needs to do that themselves, but it does lead, the higher the assumed rate of return leads to higher funded status. So take that as you will. If we had a 7 or a 7.5% funded status, we would definitely be, a 7.5% assumed rate of return, we would definitely have a higher funded status than the 87% that we're showing. So, but either way, we're still one of the best funded plans in the country, and we still are very, very strong from that perspective.
Something that was an interesting takeaway for me, over the years we attended an event, the event NASIP and NASIA, which are really our public fund peers in other states. And so over the years we've got to interact with a lot of the staff members of these states at different events. And probably at least 5 or 6 of us have been to that event, I think, every year. And when I saw this list and looked at it, is a lot of the names on the list that we're familiar with their plan and how they operate, I have a very high opinion of. So it's interesting to see that the plans that I really respect and the work that they do, see them up on this list with where they rank in the funded ratio too, was just an interesting takeaway from me when I saw it.
Yeah, that's a good point.
That's a great chart. It really is. It answers a lot of questions. So thank you for adding it.
Yeah, I mean, and again, it's, we look at the peer comparisons and all that, and this is the other side of the coin, right? I think we talked about this a little bit before. It's like, do we need to reach for return and take more risk while we're already one of the best funded plans in the country? Whereas some of our peers that are much less funded, they may need to do that, right?
How does the legislature feel about this?
mean, I don't know, maybe the treasurer has a better understanding of that. I mean, they fully fund the required contribution every year, so they're extremely supportive. They've done that pretty much every single year that the plan's been in existence. So they're extremely supportive of it, which is one of the reasons why we're so well funded, right? That's really when you get in trouble, right? It doesn't matter if you earn 6.5%, 7.5%, 8.5% return. If you're not funding the plan, your funded status is going to go down pretty quickly. And several states, we've seen that happen over time. The investment return, you're only going to earn so much regardless of how much risk you take and how much you reach for return. But if the plan's not getting funded by the folks that need to fund it, that's when you get in real trouble. So that's one of the big keys that we have for us, is that the General Assembly's been extremely supportive, and they fund it pretty much every single year. I think only one year they didn't fully fund it, and funded like 75% of it. So that's a huge key to it.
I'll add to that answer that it's especially important for some of our new employees to put this in context. So for some of you, back when you were in grammar school or even college, in 2001, this plan was 110% funded. And my wife says, don't ever talk about percentages over 100. Of course, I'm in an environment where that's okay. Obviously, that means that it had every dollar it would ever need and had 10 pennies on top of that dollar. And I've said this until I'm blue in the face. When I got here in 2017, the plan had not achieved its assumed rate of return average for nearly 18 years. And people think that's a political statement, but they don't listen to the rest of the story. As soon as Treasurer Moore was elected, our country was attacked on 9/11. The stock market was closed. The plan lost billions of dollars. Treasurer Moore had nothing to do with 9/11. And as soon as Treasurer Kyle was elected, she was hit with a great financial crisis. The plan lost tens of billions of dollars then again. And all that's interesting, but it's especially interesting in that we're not like the Bloomberg endowment, where when we have a bad year, we can turn down the spigot. We're paid out $628 million last week in pension benefits for 1 month. $628 million. That's even big money to Loris.
Right.
And I'm going to kind of tie this up a little bit. So the reason why folks like me do not lower the assumed rate of return is as soon as you gavel out of that meeting of lowering the assumed rate of return, the funded status goes down. And there's no public official who ever wants to be associated with the funding status going down. But it's the right thing to do. And we didn't do it once, we did it 4 times in 3 years, I think. 4 times in 2 years at least. And we did it in partnership with the League of Municipalities, the County Commissioner Association, the General Assembly, OSBM. We did it in conjunction with them to make sure that they could continue to fund it. Unfortunately, outside this board, when people get into long conversations about cost of living adjustments and things like that, they don't want to hear about this part. But you can't manage what you can't measure. And I just wanted to give you some context to the measurement of this. So the General Assembly has been fully funding it except for that 1 year after 9/11, I guess. This was in 2000. This is during the Perdue administration.
What year was?
Maybe 2002. But I'm extremely proud of another board that meets in this very room to have the courage, not just once but 4 times, to lower the assumed rate of return. And the reason that should matter to you, and I got a lot of stuff going on in my head these days, but I want to make sure I say this right, and I hope somebody in this room will correct me. Every 5 basis points that we lowered that assumed rate of return required $56 million a year more in funding, recurring. So when you go from 7.25 to 6.5, that's a big deal in terms of the amount of juice that the legislature and the local governments had to put in the system. So I just wanted to give you that history to that long answer to your short question about why it is what it is. And I'm extremely proud of the board that had the courage to lower it, staff who supported me in doing this, and all of our funders for keeping it fully funded. And we did all this under tremendous pressure to get rid of the defined benefit plan altogether.
Sorry?
To get rid of it for new employees, which is what UNC Healthcare is doing now, by the way. Under tremendous pressure not to lower the assumed rate of return. And so I'm saying that doing right's rarely wrong, and this board and our staff and the General Assembly did the right thing. All the while, not going up on employee contribution rates. That was the other thing that was pressuring me in 2017. This employee contribution rate had been 6% for decades. And people said, why do you need to go up on the employee contribution rates? Well, we have a lot of people who work in state government who work in 2 jobs. The last thing we need is to go up on an employee contribution rate for people who make less than $40,000 a year. And so that's not something I've ever been in favor of. So anyway, we are where we are. And I just want to give you a history of that. If I left anything out, just...
No, and I think that's, you're right in touching on our support for that. Because as part of when we've been, and I know all the committee members have been through that here, when we've gone through the process of doing, taking a look at the numbers long term on that in the asset liability study, and you come out with the mixes and what the realistic returns are, you know, in that long term low rate environment being the basis for our risk free rate, this was a more realistic number. I mean, to ignore that to me is to say, well, we are the conversation, are you solving for risk or return? If you're not going to change the plan and you want to keep that level, then you're going to have to take a higher risk profile to try and achieve that over the long term. And you're going to introduce more risk to the funding status long term. So I think the approach stuff was exactly right, as painful as it was. And those that keep it elevated and don't achieve it, pain's still coming. You just hide it.
Yeah, you're just kicking the can down the road, right? Yeah, and the other thing that happened, Treasurer's talking about in 2000, 2001, when the plan was 110% funded. Several plans of our peers, when they were 110, 120% funded, they started jacking up the benefits that people would be getting, which sounds great if you have over 100% funded, but that quickly goes away when you have additional liabilities that are forever, right? They're ongoing. So those plans that were 120% funded in 2000, they're 70% funded now, or even worse in some cases, because those are benefits you can't take away, right? And it's, that's why it's a partnership with the entire governance, right? With the General Assembly and everybody is just trying to ensure that the long-term sustainability of the fund is there, right?
And the last thing is that these 3 things are still true yesterday, today, and tomorrow. There are less people paying into this plan than are not. Interest rates had never been this low for this period of time. The minimum retirement age was taken out of the plan 4 times. We don't have a minimum retirement age. So people were never retired this early or lived this long. Of the females in this room who go to work for state government at the age of 20 or 21 are going to draw more retirement checks than paychecks. And this plan was never designed for all of that. So I think everybody deserves credit for what we have done, not tried to do here. Other questions?
All right, moving on.
Hey, John, who's joined us? Just John.
Yeah.
John, just chime in if you have a question, bud.
No, I'm good.
So slide 22, this is the liquidity profile for the portfolio. On the left, it's our liquidity allocation by market value. On the right, it's by percentage. By policy, we try to have over 70% in what we call level 1 liquidity, which is extreme liquidity, stuff that we can generally liquidate within 3 days or so. And that's in the bottom right-hand chart. You can see that the total NCRS is north of 70%, close to about 76% of total level 1 liquidity. So something we monitor consistently, and we certainly don't have any shortage of liquidity at this point in time, which is something we strive to have. The next chart just shows our net benefit payments by calendar year. Chart we show every time. You can see that's been trending down a little bit recently, but we still pay roughly $2 billion of the plan per year in net benefits. Again, the gross is significantly higher, but when you net out all the contributions coming in from employees and employers, this is what actually leaves the investment portfolio. And moving on to the next slide. You can see the alternatives liquidity profile. So this shows kind of the cash flows for our alternative allocations, so private equity, real estate, opportunistic fixed income, inflation sensitive, and multi-strategy. You can see in the top right there, that's our total cash flows for the prior 12 months. So for the calendar year 2023, we contributed roughly $2.2 billion and received back roughly $2.2 billion. So the net cash flow was slightly positive for the year at about $58 million. But as we talked about previously, in previous years, we'd seen significant cash flows back, and we were very, very cash flow positive. So it's certainly trended down. We're more cash flow neutral now, as we saw less distributions coming back last year, and we were funding some new commitments that we made in 2023 as well. And then I'll quickly hit the next slide and then turn it back over to Jeff to finish out. So this is the valuation profile. So certain parts of the portfolio aren't valued daily. They're not valued weekly. A lot of our alternatives are valued quarterly. So we kind of show this as how much of the portfolio is in each one of those categories. So you can see on the bottom there, the big blue section is the daily valued portfolio. So it's about 75% is daily valued. And then you can see about another 9% or so is monthly valued, which is that orange section, and the orange and the gray section. And then about 15-16% is quarterly valuation, which is more of the illiquid private equity type strategies. Okay, turn it back over to Jeff if there's no questions.
Flip over to slide 26. Take a look at the asset class net of fees performance. Really focused in, and we've been talking about quarter. Really, this is the 1 year number on it. So really, your high performers there, obviously, were public equity, opportunistic fixed was strong, as well as multi-strat. Growth as a whole was kind of mixed. You had the public equity good, private equity, you got the normal timing thing that we always have during shorter time periods. And then on the weaker side of things really was across real estate, non-core real estate, suffering, and core real estate there as well across that. One thing kind of embedded in there, might be as good a time as any to touch on it, on a really good story front, is to update you on a couple of things that we did within fixed income that we mentioned, I think, at the last meeting. So we talked about what a strong quarter it was. We also benefited from the timing there. We moved $2.2 billion through the late part of 2023. Back into that portfolio, kind of getting those exposure up that you saw of the total plan level. So that was really a fortunate timing on that piece as well. And then to touch on into something with we've got a full calendar year on it. If you remember a while back, we started something new, which was to do some short investment grade credit, really in lieu of our short-term fund as a whole, as we saw higher yields there in that space with the credit side, and it was really quality short IG credit. And now we can kind of take a look at that and say, well, did that add value or not over time? We put a total of $1.8 billion to work there, and if we look at the calendar year 23, that portfolio did right at a 5.4% versus sourcing it out of STIF, which was the 365. So picked up a pretty material amount there, doing some really high quality short names. That was just a function of an opportunity that existed in that environment that we know that's kind of disappearing to some degree now, but we did take advantage of it at the time. So good part of the story there. On slide 27, no observations here, considering sometimes there's a different time period between the last chart and this one, but since we're a calendar year, that data on the far right is the exact same as you saw on the last page. So nothing really new to report there. Moving on to slide 28, looking at new incremental and unfunded investment commitments. On the left-hand side of the chart, we've got 3 new items there to report since our last meeting. One in private equity, one in non-core real estate, and one in core real estate. All those closing in November. And then looking on the right-hand side at the total amount at the bottom, really that net number's up $100 million since we sat down last meeting. So it's $7.1 billion. It was right at exactly almost $7 billion last time we sat down. And then a different representation of that on the next chart on slide 29, we can see where we are there as an amount there. There's a 7.1, and right below that is the percentage of total plan. Last time we sat down, that number was 6.26, so it's down a little bit from that number too. So that's kind of stay at steady state here.
Jeff, can I interrupt you?
Sure.
And it may be a Troy question, but just to go back to that previous chart if we can.
Yeah, slide 28, yep. With the notes, yep.
Some of these were,
One of them was the Rockwood Capital, taking out our own debt.
yeah, just tell them what we're doing here.
State your name and
Come on up,
position.
Troy.
March Director of Real Estate. So one is a new relationship. North Pond Partners is a new relationship focused on small strip malls, non-anchored grocery centers. The other one, which is what I think your point was, Rockwood Capital, is where we're taking out our own debt. We had debt in a separate account where we owned 100% of the asset, and rather than pay somebody else 7.25 or whatever the number was for this, we've done several of them now, but we decided we were better off paying ourselves and taking out that debt and owned it 100% equity. We've got a couple more of those coming over the next year as well.
Just a question. I mean, didn't some of those have the potential of rolling into double-digit interest rates?
No, the ones that we've done thus far have not been that bad, but there are potential ones in the future that could be double-digit interest rates, office properties. This property, but this was a very 100% well-located property. We could have got debt on this one at around 7% through the CMBS markets, but we decided to just do it ourselves.
But we have been paying what interest rate?
It was much lower.
3 or 4?
Yeah.
Okay. So the interest rate had the potential of doubling
Yes.
on an asset that we own 100% of. And they did a net present value on that, determined it's the best interest of the plan for us to own our own debt.
Yeah. But we always have the flexibility to lever it back up if rates go back down in the future.
Sure.
Given we don't have any partners, we own it 100%. We just have full flexibility on that. In the meantime, it just seemed to make sense. We're clear our hurdle rate. Why not de-risk it and de-lever it and pay ourselves rather than pay somebody else?
Before we go to Mike's question, Mr. Mevin's question, but we have more of these coming up.
We have more opportunities. We don't have obligations.
Right.
We have other separate account assets coming up. One later this year would be a multifamily asset. The same kind of scenario where this was slightly different in that it's a floating rate debt, but because it's floating rate, we can take it out early without any prepayment penalty or defeasance. But it's fixed at a higher rate because of the swap cost. We have done one of those earlier this year or last year, a similar situation where it just made sense. Instead of paying that swap rate of 7.25, just take it out. And so we'll be evaluating that later this year. And then next year we have an office asset that's rolling that we should be able to get debt on it if we wanted to, but that rate would probably be high single digits. So we'll evaluate that when it comes to see what happens with mortgage rates in the market.
And Mr. Mevin?
Are there any inherent risks that you don't expect in a more of a traditional lender-tenant relationship?
Well, when you take out the debt, the biggest, I guess, not risk, but change is you lose that ability to, if things just really go south from here, to turn the keys over back to the bank. when you have a loan, you always have that ability, there's some amount of risk on the bank and not you. But when you pay off that debt, then you no longer have that ability if things would really go south from where we're at now.
So if things go south, it's us that go get the keys to the building.
Well, we have the keys to the building now.
Okay.
There's no debt. Yeah, but these are.
But so you've got to do a workout on your own, separate. If there's a bank, they would have to figure it out themselves, take the keys back.
That's right. We're managing these buildings because we own them 100%. We're managing them ourselves now. So, but generally these buildings that we own, whether they're multifamily or office, as the case in this one, this was 100% leased property with strong credit tenants. There was no workout situation involved there. Our multifamily assets that we refinanced were very well located, newer buildings, stuff that we really liked. If we had a building that was 50% occupied, we may not do this similar thing where we take out the debt ourselves. We may not, but we don't have that. That's not the situation really with any of our separate account assets.
That leads me to the question. Is this being done in all projects that we're in that fit the credit profile? Can you do this, and is there any limit to the amount that you could roll into this type of program? Because it seems to me if you're going from paying somebody else 7, paying yourself 11.
We're evaluating it in all our separate accounts, like for example, industrial. We've considered that. We've decided not to do that in our industrial because the question becomes, is your debt accretive or not? What's the cap rate on the industrial assets, and what's the debt that you would have to pay? Industrial is about a wash at this point, so we're on the fence of whether that would make sense. Our industrial portfolio is already very low levered at down around 30% leverage. Other asset classes, we're on a case-by-case basis, we're evaluating every opportunity that we have for this. It's would the debt be accretive or not? What's the overall debt profile of the portfolio look like? Things like that come into consideration. Does that answer your question?
Thank you.
Yes.
And if we ever decide to sell this building, I guess it's no easier to sell it without debt, but it's got to be one less complication.
It's definitely easier to sell it without debt.
Yeah.
Sometimes when you sell a building with debt, depending on where your debt is, that can be an asset or a liability. It's generally assumable, but it's just one less complication, as you said.
And Ron may have more to say about this because Ron and Troy and their teams work together, because there's some things that Troy sees needs to be done. But it's more in Ron's category, so we'll probably hear a little bit more about that as we go forward. Any other questions? Thank you for explaining that. I'm sorry.
You good? Flip on to
I
slide
think there's
30.
going to be more of these coming up. That's why I see to be aware of the process we go by.
I'll pass 30 there. There's nothing on that back.
It's got a leg.
No, it's fine. Yeah, nothing on the exit and investment side on 31. So 32 just has our top 20 managers. I'll tell you that the cumulative amount there for our internal between fixed income and equity, a number was 54%, now 54.4, up a little bit, really driven by the return profile that we had in equity there. And the only other change, we usually bounce around on that very last name on the chart there with Franklin Templeton. I think it was Marathon last time we sat down. So other than that, pretty steady state on the information that's on that chart. So.
Are we good with those percentages of internal versus external, or do we want to expand our efforts to bring some of that in-house?
Yeah, I think we're always looking to do more internal. So we've brought more internal. We created our internal core strategy a couple years back now. So we put some money in that. We're thinking about upping that a little bit. So we're continuing to look at it. Again, conversation of how much can we do internally with the resources we have versus how much, kind of need to outsource. So, we would like to bring more. So we're constantly looking at that, but it's just a matter of, whether it makes sense.
But I think that the growth would be there. We were already managing all the investment grade internally already. So other than the asset value change, it might would be just what Chris.
Gotcha.
I don't want to go too far into this, but how is our relationship with BlackRock right now?
I didn't get a Christmas card from them. Or last year. I can't remember when I got a Christmas card. Go ahead.
No, I was just gonna say, from our perspective,
Largest external.
from our perspective, it's fine. The vast majority of the money that they manage for us is passive, so it's them tracking an index. So they do a very good job at that. They do, they're the biggest asset manager in the world, and then they do a lot of that. So, from the investment perspective, they do what we ask them to do, and the relationship's fine.
Okay, thank you.
I would just add, because it's no secret to people in this room, I have 2 jobs these days. And I get criticized because people see this. Why didn't you do what other states did and exit BlackRock? And there's a long answer to that, but basically our loyalty and duty of care is to our members. And what BlackRock was doing was politicizing our assets through ESG policies. If you've read the paper in the last few weeks, now Larry Fink is pointing the finger at everybody and said everybody has weaponized what he's trying to do.
Right.
When I think it was Elon Musk, I forget the word. What was the word, Frank? Whacktivism.
Whacktivism,
Okay. So now we got whacktivism coming from Elon Musk regarding ESG policies, and then we got Larry Fink saying that he's been weaponized because of his approach toward this. And people really don't want to hear the truth. The truth is that if somebody can show me how, including the people in this room through internal management, how to manage an internal index fund, international, different currency, different time zones, different accounting standards, cheaper than these people can, then they can get the business. But the fact is, nobody can do that. And our loyalty has to be to our members, not to some political jargon. So what we did is we negotiated our fees. Rhonda and her team negotiated these fees down to the lowest possible rates. Number 2, we pulled all of our proxies out away from BlackRock. Those proxies are now voted with the culture that represents this plan, our state, and our citizens. And then the third thing, which is probably the reason I didn't get a Christmas card, asked for Larry Fink to be fired. That was 16 months ago. That didn't happen. But what did happen is they're not the number 1 money manager anymore, I don't think. Vanguard is. And, they go neck and neck. But the fact is that as BlackRock was going down this path, it's hurt them from a market standpoint. And now they're backing off of ESG policies. So the reason BlackRock is still here is because I'm fulfilling my loyalty and duty of care to our members by keeping it there. And I will say to Matt and Greg and Rhonda and all the other team, when they made the internal index fund jump up on the table in 2017, about a year ahead of schedule, they, at that same time, were looking at how we could possibly bring the international index in-house also. And it doesn't matter if they think inside the box, outside the box, and when they tried to use both sides of the box, the fact is that we were just not in a position to do it better and cheaper.
Well, it's 10% of your portfolio. How quickly can you turn over 10%?
Right.
Would be a very difficult challenge. So.
Yeah. So I'm proud since we stood up the internal index, domestic internal index platform. You would think with a new treasurer and standing something up that when the treasurer asked the team about international index, it would be a human nature for the team to come back and say, yes, we can do that, treasurer. But it wasn't the right thing to do. And that's exactly what they came back and told me. They would love to have made it work. They wish the analysis would have come out differently, but it didn't. So that's why we are where we are. But BlackRock does not vote our proxies anymore. Period.
Any other questions on the side?
Thank you. John, any questions? And we're still #1 in North America for efficiency.
From the team data? Yeah.
With the U.S. public funds, I think is the more appropriate way to put it. But a lot of the Canada plans are differently structured than us.
Fred, what was his question?
Whatever the question was, I've been answering it wrong. Is it Talon?
CEM.
CEM has designated our plan as the most efficient plan in the United States. Plans over $50 billion 2 years in a row.
Yeah, versus, yep. Yeah, I mean, that's the analysis we look at every November.
Last time.
Yeah, we went over that last time.
Who's up?
On and me.
All you gentlemen.
Good morning.
Morning.
Good morning, Ron. Hey. This gives me great pleasure to present to you today for two reasons. One, we get a chance to talk about the success that we've had in the inflation-sensitive portfolio over the last year or so. And then number two, most important reason why I'm really excited about today is my mother's 83rd birthday, and she is listening in right now.
Is she on the plan? Is she on our plan?
She is a member of the plan. She retired in 1995, and she's been a beneficiary for 29 years, and I've worked here for the state for about 15 of those 29 years. And so that's
How long did she work for the state?
She worked for the state for approximately 34 years, 35 years, yeah.
So just an example of someone who's going to draw more retirement checks than paychecks.
I pray that that is the case.
Well, what was her first name again?
Janie Funderburk.
Okay, so we're going to pray by singing her happy birthday. Say she's listening.
She is listening.
And it's for you. Go ahead, lead us.
Happy birthday to you. Happy birthday to you. Happy birthday, dear Mama. Happy birthday to you.
Yay.
Whereabouts?
Winston-Salem. Yeah. And just like a mother, in true fashion, I called her this morning and told her we're presenting. And she said, well, how many slides do you have to present? Told her 20. She said, goodness. Keep it simple. Keep it short. And so we're going to, in that spirit, we're going to try to not rush through, but we will deal with our slides in a very efficient fashion if we can.
There's a slight lag. Vanna's over here.
All right. So this particular slide shows the role of the inflation-sensitive portfolio. There are about 5 things that this portfolio has to do to meet its objectives. 1, to provide some degree of inflation protection during periods of inflation, provide absolute returns, provide competitive relative returns to commensurate benchmarks, provide the plan diversification, and also provide liquidity. Hopefully this particular slide deck that we're going through will address our performance in some of these areas. Next slide. Currently, the inflation-sensitive portfolio stands at a market value of about $5.5 billion. We're currently $1.5 billion short of our target weight, and that is okay to be short of your target weight for a number of reasons, but we have about $1.5 billion that we have the potential to allocate to sub-strategies in our portfolio if we were to meet our target weight for the portfolio. Next slide.
There's a leg,
No worries.
10-second leg.
Okay. This slide shows our 10-year portfolio history going back to December 13 or 2013. You get a chance to see how the portfolio has grown in value. You can also get a chance to visualize how the portfolio has been diversified over time. Since the inception of this portfolio, the portfolio was mostly in publicly traded natural resources and timber, which is a private natural resource allocation. And then over time, you see that the portfolio has diversified into green, gray, and blue areas, which has provided positive diversification for the portfolio. There are other slides in the appendix that you have a chance to review at your leisure that also show a little bit of the history of the portfolio broken down in Word format. There we go. And then this slide shows a little bit about our portfolio history as it relates to commitments. As you see, over the last several years, we've increased our commitments to the green, which is the other real assets and diversifiers. And that has also been a very, very positive contribution to the plan. And I'm going to hand it over to Ming.
Good morning, everyone. In the next few slides, I'm going to go over the portfolio compositions, as well as the performance and how we look at the benchmark and some of the inflation drivers we are particularly tracking. So as of December, end of last year, the sub-portfolio is roughly as following. There's just over a quarter is allocated to the inflation-linked bond sub-strategy, and about just about over a third of the portfolio is allocated both to private natural resources and other real asset and diversifiers. And then there's about 4% is allocated to public traded natural resources. As Ron has just alluded, the public traded natural resources have been coming down as of the importance for our strategy, and while the other real asset and diversifier has become a much more important component of our portfolio. Next slide.
Okay, quick question.
Yes.
Make sure I'm reading this right. So we're saying the 20% of the 36% that's timber?
Yes.
The 20% of our private natural resources is in timber.
Yes. We got about $1 billion worth of timber portfolio out of $5.5 billion total.
It's a little bit actually, it's not the 20% of the private natural resources. It's 20% of our $5.5 billion total allocation is within timber. So the 20 plus the 10 plus the 6 all aggregate to that 36%. Meaningful number. And then last year, timber grew by 18% market value, by the way.
Wow.
In terms of
I want to answer the question not knowing the answer, so I'm glad you talked it out.
18% in 1 year.
Wow.
Yes, sir.
Are you liquidating?
We're operating those assets, and as part of operations, we're able to gain yield or distributions for income. And then opportunistically, we've worked together with some of our managers to sell assets where it makes sense based on the liquidity at that time on which we embarked upon a sales process.
Yes.
There are actually interesting opportunities coming up. Some of our timberland is next to some of the electric grid connectors, and then we got proposals to turn them into solar farms. So instead of having trees absorbing the sunlight, now we have solar farm to absorb the sunlight. So,
yeah.
So turning to the next slide, this is the benchmark.
That was such a good meeting before you brought timber up.
it was going to be a great day, right?
Didn't get the memo. Go ahead.
It's James' birthday. You should never bring timber.
Go ahead. So this is how the benchmark, our inflation sensitive portfolio is indexed to. And for the long-term target benchmark, there's about 1/3 of the component is in TIPS, is essentially the inflation-linked bonds issued by U.S. Treasury, and 17% is the Bloomberg Commodity Index, so that included the energy like oil, gas, and some of the industrial metals, and then the 50% is what we call dynamic blended sub-benchmark, because this the complexity of some of the inflations, the drivers that inflation has, and if we break down that further, the dynamic blended March and the dynamic blended sub benchmark, and shows this component, you can see in the right chart, that's the different more subcomponent of our current benchmark. About 20% is the timberland, is just about what we try to target our portfolio's timbers returns, and then about 9% is the energy index. So that's private energy index. It's not publicly listed, and then another 18% or 16% is the infrastructure index, and the remaining is inflation-linked bonds.
Can you give us a short version of, as interest rates have gone from 100 basis points to 500 or 600 basis points, how did TIPS perform in that environment?
We have a slides that coming up.
All right, I'll show you.
Poorly. So the inflation-sensitive portfolio returned 7.9% last calendar year. On the top, as you can see, over the different time horizon, whether that's 1 year, 3 year, 5 year, 7 year, 10 years, or since the inception of the strategy in 2009, the inflation-sensitive portfolio has outperformed its benchmark, and most of the period quite meaningfully. If we look at the calendar year performance, we have outperformed the benchmark for the past 6 years, with the exception of year 2020. That was during the COVID, and inflation is no longer a concern, but deflation was the concern. Next slide. That was just breaking down of each sub-strategies within the inflation-sensitive portfolio. As you can see, probably very, very difficult because there's 4 components within it, and a lot of these return numbers are kind of stacked on each other. But the message here is all the sub strategies has outperformed its benchmark. As Ron alluded to, last year the timber portfolio has returned 18% due to a very favorable mark-to-market, and that's dramatically outperformed its benchmark, just around 8% last year.
So on this slide, Treasurer, the blue line to the left, the blue dash, is the 1 to 3 year TIPS performance. You see that is just north of 4%, whereas our inflation-linked bonds portfolio, which is a proxy to TIPS, it's not. We designed that portfolio not to mimic exactly TIPS, but to be a proxy, because we thought that there were some inherent flaws in TIPS, that if rates were to rise, the duration component of the TIPS exposure would be negative to the performance. So we created what we call it, internally we call it a staging portfolio, an inflation-linked bond portfolio, something that has less negative exposure to duration in the event that interest rates were to rise. And you see that over that 1 year period, our inflation-linked bond portfolio performed meaningfully above the TIPS.
8%?
Yes, sir. That's.
So it sounded so good, TIPS, protection against inflation.
Yes, sir.
So who was it's not likely the federal government was smarter than the markets, but it seems like the federal government issued a product that sounded good, that people thought would protect them, but it really didn't.
Yes, sir.
We'll show you in the next slide, because the market in general, I think, has confidence in the Federal Reserve in terms of managing inflation. As you can see, that really market expectation on inflation doesn't really change over a very long period of time.
To your point, it's a misunderstood product, in my opinion. I think it was a year ago we talked about and gave the numbers. I think it was 2022 was a calendar year when they got slaughtered. And the part is you're still exposed to real rates. Mm-hmm. And you get the inflation component, but if real rates change underneath and you have interest rate risk through duration to those products, you still get killed. And that's what happened, especially with longer tips of duration. I think, if I remember right, I think the returns were like negative double digits for longer tips during that period.
But when you're evaluating it like that, are you putting in the return to principal that comes inherently? That's part of your calculation.
Yeah.
We have a chart in the.
So how much tips do we own?
The short tips get what you get basically.
In that portfolio?
Yeah, period. Longer tips got.
In that portfolio, we own approximately, I want to say $1 billion to.
So given all this, why don't we own any of it?
But again, we don't own tips.
No.
We own a small piece of tips.
Yeah, $65 million of tips.
In actual tips.
In
We own
actual tips.
the tips portfolio, which you were talking about.
Correct.
The inflation-linked portfolio.
Correct. We have $65 million in actual tips, but $1 billion in what we call our staging or inflation bond portfolio. That is to mimic the positive attributes of tips and try to avoid some of the negative attributes.
So if somebody were just to look at page 7, they could incorrectly assume that we have 33% in tips if they didn't read what those words said.
If they didn't understand that that's the benchmark, we should be judged by tips if we're trying to. It's the benchmark. We have to provide going back to the first slide, we have to provide a relative return for the risk that we're taking, and the best proxy is to judge it against tips. Some of the floating rate investment grade bonds that we have in our portfolio.
Your mom wanted me to ask that question.
Oh, no worries. I think she wants you guys to ask a lot of questions, but for sake of brevity.
Okay. I mean, in the future, should we put something in this chart, because a person looking at this for the first time would say, this product that's so inferior, it's performed so poorly, we have 33% of something in there. I think it needs more, even in that pie chart, it needs a little more clarity about we do not own tips.
But one of the
happy to.
One of the tips attributes that is misunderstood is how it's actually calculated through the last 30 days of the Consumer Product Index as published in their website. So, and the second thing is each month it returns principal back to you, and that helps the overall return if you guys are calculating right. But it's a favorable in certain circumstances based on the 30-day Consumer Price Index and
I think that's a good. We're open to changing in the future, but I think the average investor, which what we've been hearing about from other pension plans, other endowments, other folks, to protect against inflation, they actually own tips. We're actually an anomaly in designing a staging portfolio. That's something that collectively we as a staff did. Jeff, Kevin, my staff, other folks collectively. This was a big project when we did the staging portfolio as a group a long time ago. So I think other investors don't have this product. To be very specific, the two managers that manage this portfolio for us, we're the only one in that product. And they've done a really good job managing this portfolio for us. And it was a collaboration between us and the managers at the time. And we tried to isolate some of the better qualities of what we're trying to achieve and avoid some of the negative qualities and characteristics. So I actually think the average investor looking at this probably does need to see U.S. tips, because that's what they're investing in.
Just to be clear, talking about a different style product between individual purchasing and how it's marketed versus a plan. To Mike's point on it, so I mean, your coupon is fixed.
Low.
What is low, and what adjusts is the principal amount. So depending on the CPI print, the amount you roll the principal is adjusted up or down, and that's where your valuation change comes. So over time, held to maturity, your principal is going to adjust, and you're going to realize whatever the CPI is prints over time to maturity. So you're going to get that adjustment. What's going to happen in the interim, though, like any other bond, is when the payments are fixed, is your valuation is going to change based on the underlying expectations of inflation going forward, and that basically is represented through the break-even rates and the security on it. So
Very, very briefly, I mean, is there any scenario where people who are invested in tips, because we have this in our 403, 401, and 457, is there any economic scenario where people who are invested in tips would make money?
Can I quickly answer that? In our space, we're the only people that use tips also. And I can't remember the exact year. I will go back to 2017, 2018. It was our highest earning asset class. And we were knocking them out of the park with tips then. Now for the last 3 years, it's been the worst performance for us. But we're still protected because we are getting that distribution of principal out on a monthly basis. So I'm not so negative on them, but they are difficult to understand, and I really don't understand them myself. So
It would have taken a lot of courage to short tips, which would have been the right trade. Given what we've experienced with inflation, that would have been a bold move. So anyway,
again, it depends on which tips you own, shorter or longer maturity. Sure.
Okay.
Because there's going to be a duration component. You are exposed to changes in real rates. So just like owning a long bond, when rates change materially and rates go up, and it, when that valuation plummets, the same type thing occurs there. So you are capturing the changes of the principal. The valuation of your underlying security could change.
Thanks. All right.
Ron, let me know if this analogy is too simple. So the internal staging portfolio versus the tips, you were ahead about 400 basis points, right?
Just for last year.
Yeah, okay. So if you have 1.4 billion, that means your staging portfolio added $56 million to the plan as compared to if it all had been in tips.
I'm not a human calculator, but yes, I think that's a
I just want you both to be proud that you helped the plan gain $56 million last year.
No, thank you. Thank you. Thank you. Thank you. Okay, let's move this chart here.
Okay, move on to slide 10. That just shows the inflation-sensitive portfolio correlation against the overall pension plan and other portfolios within the pension plan. It shows we have a very, very low correlation against the overall pension plan and also other strategies, with the exception of the opportunistic fixed income. That's probably due to these two portfolio was managed by the same team, and as well as we think about the inflation sensitive strategy, we tend to think that we can incorporate the floating rate component to our strategy. That is very similar to opportunistic fixed income, and because the floating rate is indexed to the Fed fund rates, which moves with the inflation with a lag. So we think that is effective in protecting the inflation impact on our investment. The bottom of the slide shows over the last 3 years the net distribution and cumulative distribution we have received from the inflation sensitive portfolio. As we can see that in 2021 and 2022, we have received meaningful distributions. That went down pretty meaningfully in 2023, but still we received $156 million worth of distribution in 2023. Cumulatively, we received $1.7 billion distribution from the inflation-sensitive strategy, and that explains mostly of the gap we currently have for our portfolio against our target. Next slide. The next slide just shows the current CPI composition as published by the Bureau of Labor Statistics. as you can see, without surprise, the number one component for CPI that commonly people feel is shelter, about 35%. The next biggest category is transportation, about 17%, that including car purchases, public transportation, so on and so forth. The number three category is food and beverages, and the number four is medical care. So when we think about our inflation sensitive strategy, we try to invest in assets that's linked to these big categories. Next slide. Now we look at how CPI progressed over the years. As you can see that after the COVID, CPI reached a peak around the beginning of 2022 at 9.1%. Over the period of the last 2 years, has gradually, steadily came down. So the current CPI as last month stood at 3.1%. The core CPI is less volatile, which is exclude the food and energy, is still at 3.9%. So we have made meaningful progress in terms of bringing down the CPI, but still has some way to go before hitting the Fed target around 2%. Then the bottom of this slide is actually what alluded to this, what we just discussed about tips. So this shows blue line is a 10-year break-even rate, which is essentially derived from 10-year tips that trade in the market, minus the inflation component. That will tell you where the real rates that investor want to be compensated for investing tips. As you can see, and then the orange line is the 5-year break-even, 5-year forward. That basically tells you where investors expect the 5 years from now, where 5 years real rates is going to be. As you can see, this is actually pretty steady over time for the last 20 years or so. Investors in general want to be compensated about somewhere around 2 to 2.5% in terms of real rates, regardless what the CPI does. So that's why you guys we have seen this. The tips is not a very well understood investment vehicle to protect against CPI, against inflation. Next slide. This is what we shows one of the what we believe is the prime driver for inflation is basically the labor cost of our economy. So as you can see, the current labor market remain very, very tight. There's about still 9 million job vacancies currently available, and then the unemployment is still at 3.7%, which is almost historical low. Some people will argue that we are actually at full employment, and that has driven the average hourly earnings at very robust clips. The last time the statistics was announced, the average hourly earnings still increased 4.5% year over year. So when the wages are increasing at 4.5% year over year, it's very difficult to get the CPI below 3% or to the Fed target at 2%. And the next on the right at the bottom, and this just shows private sector's average weekly hours people worked. It's now at a historical low at 34.1%. So a lot of people after COVID no longer willing to work long hours, and they try to get a better work and life balance. That also contribute the tightness in the labor market. So based on what we have seen, we believe that the rate is going to stay higher for longer because the very tight labor market we are facing right now. I'll turn back to Ron to talk about the next big component of the inflation.
Okay. That'll be quick.
Meg, just,
Yes.
you're not old enough to remember stagflation, but I am.
Okay.
What would you, not ask you to be an economist, but what would you read in the paper, or what would you see at the grocery store? What would you feel as just a citizen that would say we may be heading in that environment, which is a killer for pension plan returns?
Um,
Higher cost, lower economic activity.
I mean, from what I can experience, definitely we can see the price pressure, whether you go to the grocery store or go to restaurants. And I'm currently trying to purchase a home in the Raleigh area. It's definitely out of control. So I would say we feel the inflation pressure around us every day. But at the same time, I don't hear a lot of story of people losing their jobs or are employed. So I think that creates so far an okay, they call Goldilocks environment where economic activity still stay relatively strong, but we are still feeling the inflation pressure that carried over from the last couple of years. So if Fed does their job right and keep the rates higher and try to bring the inflation down further, I think we might be okay. But as soon as I think people losing their jobs, then we might get into the scenario that you are alluding to, which is stagflation. So it's really, I think, depends on the job creation in the market. For now, I think we're seeing headline news that a lot of high-tech jobs are cutting their jobs. But at the same time, from what I can observe, a lot of these people being laid off by whether Google's or Meta or whatever, they find jobs in small startups very quickly. But nobody was employed for more than 6 months. Most people find the jobs within the next month or 3 months. So I don't think overall, these are big companies tend to hit the headlines that they're cutting a lot of people. But at the same time, I think that the economy is robust enough that people are still getting hired.
Thank you.
I echo those sentiments. Unfortunately, I think the impacts of inflation will be here to stay much longer because typically prices don't go down. Prices are sticky, and so it definitely will change consumer behavior over the long term. This particular slide recaps a little bit of the housing market. As Ming indicated, the number one thing on this slide is the bottom left corner, in my opinion, how the affordability index is near the last 20-year low. So if you're trying to buy a home with regards to the high interest rates and the current prices of the home, you're stuck with high mortgage costs or high shelter costs, which we alluded to as a big portion of CPI. And then also the month supply of houses is actually much lower than on average, just because a lot of folks do not want to sell their existing house. Saw on CNBC this morning where new homes, people are increasing their purchase of new homes where new builders are providing inventory to the marketplace, whereas existing home sales are relatively muted, as someone with a low mortgage does not want to sell in this environment and be stuck with a new mortgage or buying a new home where the new mortgage rates are much higher than what they currently have. Next slide. This just alludes to how increased interest rates have kept the dollar strong, which impacts or keeps lower the cost of inflation related to imported goods. So if you have a strong dollar, any imports that you have from international geographies will be much less on your wallet. So next slide. This one's always a fun one to show. I think Jeff, the fixed income team, typically shows this one as well when they're presenting. This is what the market believes how the Fed will behave in the coming months with regards to rate hikes or rate cuts. Right now, they're predicting rate cuts will occur sometime in June, and then the market believes that by the year end, December, there will be 4 rate cuts. Typically, this particular slide is always wrong relative to reality. If you go back and look at it, it always shifts, but it's just always fun to see what the market believes.
That number's down to 3 this morning.
It's down to 3? Okay, and as we printed this was February 15th when we printed this as part of our...
That's been changing with new data coming out.
The 4.2 goes to 3?
As far as the number of cuts.
Yeah. And at the beginning of the year, it was
They're showing
many more cuts.
as you turn the calendar. But that's what I was mentioning earlier is at the end of last calendar year, We were basically calling for 4, and they were calling for it to be done before we hit the summer.
Right.
And now they don't show that. Now the first one's not until the summer. Calendar year. So that's been all over the place.
Yep. And I think we'll be here for longer at this level, for longer, maybe even a hike. Not sure how Chairman Powell will react or move on a go-for-it basis, but I don't necessarily see cuts in the near term, given some of the things that we just talked about.
Are you guys tracking potential black swans and how they might affect what your strategies are?
We try to, but there are a lot of unknowns that we're just unaware of, and there are some things that we think that could be deflationary in nature, as in if the Fed continues to raise interest rates, how will that impact economic activity, things of that nature, war, the multiple fronts of wars that are going on globally. We try to think about that, but we still try to put together a portfolio that will be balanced. No one can. It's hard to predict the unpredictable, but if we have a balanced portfolio, really diversified, over the long run, markets seem to behave normally.
Great, thanks.
And then at the bottom, you see how the Michigan survey, the inflation expectations for the upcoming year would be in the 3% level. We're already wrong about that based on most recent data readings. Next slide. This slide highlights the inflation surprises index over a period of time, both domestically and globally, of major economies. And I want to highlight when there are inflation surprises, that's when we really want our portfolio to perform, as we discussed earlier with the first slide of the deck, with the role of the inflation-sensitive portfolios to perform when there are surprises. And I do believe that our portfolio has matched that in this particular period of time, with over the 2020, 2021 through 2023 time frames. What does all this mean? It really means life is uncertain at best, and our inflation-sensitive portfolio is uncertain at best. Just like Mr. Mevin was discussing, what are some of the black swans? We really don't know, but we think and try to categorize certain things into different categories based on if the Fed maintains high rates, or if we hit a recession, or if wage growth kind of lowers moving forward. There might be downward pressure to inflation, and then maybe our commodities exposure may get hit really hard, or our energy exposure may get hit really hard. But we try to keep that relatively muted. We're always trying to figure out what will be the downdraft to our Timberland portfolio. How do we monetize that portfolio in a way that makes sense, where we're not taking any type of haircut, where we're actually benefiting from some of the benefits associated with higher inflation or the demand for housing being so high. And then there's always potential upward pressure for inflation with regards to the continued supply chain disruptions, and also different shipping routes and things of that nature that we saw happening in December. We thought it was going to yield a higher print later, and subsequently it already has. So we try to think about these things, what's happening in real time and how that might impact the future, but it's hard to move a portfolio around based on a lot of the short-term views, especially when you look at our portfolio. Only a third of it is daily priced, very liquid, whereas a lot of it is in closed-end funds that where you make long-term decisions to hold high-quality assets over the long run, like cell phone towers or data centers and things of that nature. We're not selling in and out of a data center daily. They have long-term contracts with high offtake agreement counterparties with groups like Microsoft, Cisco, everybody, things of that nature. So even though things may happen in the near term, we're not trying to unwind and invest into long-dated infrastructure assets based on something happening last week. Next slide. And then These are the areas where we continue to think about where there may be gaps in our portfolio from an exposure perspective. And these are areas where we feel like may have future potential in our portfolio. As Troy was alluding to earlier about the real estate market, how debt is very expensive and how it may make sense to pay down debt. And if debt is so expensive, it might be an opportunity to be a lender to hard assets. And so that is something that my team and Troy's team, we are collaborating upon opportunities that might be in the real estate debt markets where you get a chance to lend to a hard asset at a very low LTV, or you have a borrower who has had an asset for multiple years. They come to refi and they cannot fill that gap. They don't have the capital to pay SOFR plus 500 or 10% or more for high quality assets. So we're working with managers and we're trying to figure out how do we take advantage of lending to hard assets in a manner that would be consistent with our inflation sensitive portfolio. It's not to say we want managers to call us because we're talking about this here, but next slide, which they do. Strategic considerations for 2024. What does this mean for our day-to-day activities? We're going to focus on high conviction opportunities with limited downside risk, maintained through our custom mandates. We're going to consider monetizing strategies that may be more susceptible to deflationary pressures. Last year, worked with the broader team to reduce some of our commodities exposure in the commodity futures area once we thought that opportunity had sailed, and knock on wood, some decrease in some of that exposure has turned out to be really thoughtful for the plan, and we're going to continue looking at ways to monetize the portfolio. Again, over the last 3 years, we received $1.7 billion in net distributions. Our portfolio is only $5.5 billion, and over the last 3 years, we received over a third in net distributions. That's my opinion. That's pretty strong from a monetization piece. So we're going to continue number 2 where it makes sense. But number 3, we're going to opportunistically increase exposure to high quality real assets and infrastructure assets where it makes sense. That's just our mandate, and that's just what we're going to try to do when it makes sense, whether or not there's dislocations or whether or not there's further opportunities to add to our high conviction fund managers in these areas. I think that will do it for our inflation sensitive report. Hopefully I made my mom proud in keeping this thing quick and short.
Good questions.
Good information. Thank you.
Okay.
Well, any asset class where we get to talk about timber and tips in the same day.
A lot of fun. On Jane's birthday.
Good stuff.
Now,
I do have one unrelated question.
Yes, sir.
Treasurer, you guys were out looking for private equity opportunities where you had enough cash, other people might have had liquidity problems, and you were trying to get into more lower cost assets that have a higher appreciation. Is that still in the works, or you guys have any
Secondary strategy with Landmark.
Yes, sir. Our secondary strategy is a subcomponent of that green bar, whereas diversifiers and opportunistic diversifiers. And that is something we're continuing to do, and it's performed really well for the plan. And yes, sir.
That touches obviously not only Ron's area, but private equity, Craig's.
The opportunity set is really expanding.
State your name and position.
Sorry, Craig Demko, Director of Private Equity. The opportunity set. A lot of our peers are having cash crunch situations, and they need to.
and maybe allocation issues as well?
Yeah, that's really what it is.
In addition to that, Craig and I were working with our managers to evaluate the new phenomenon in the marketplace called continuation vehicles. I think investors may fall on the side of they dislike them or they do like them, but continuation vehicles is also a place where our secondary managers are taking advantage of liquidity of various portfolio companies, and they are, for the most part, making very profitable investment decisions with regards to several of these continuation vehicle opportunities.
Any other questions?
Yeah,
Go ahead, John.
Somebody's getting their tree cut down next door to me. Two comments. One, I follow a publicly traded REIT that owns timber, and they announced, I think about 3 or 4 months ago, that the private market value for their timber is much higher than what the public is paying them. So they're in the process of liquidating. And I think the stock's gone up about 35% since the announcement. And then two, I think is the Yogi Berra of our meeting today. And I quote, "It's hard to predict the unpredictable." I'm going to keep that comment for the future.
That's not the last time he's going to hear that today.
Thank you.
John, you skipped out on the first part. Did you say there was a timber REIT that is liquidating because the fair market value of the underlying assets is the REIT selling at a discount?
Yes, so the public market is not paying as much as the private market. So they're in the process of liquidating, not the company that is strategically liquidating millions of acres. And the stock's gone up about 35-40% since then.
What's the name of the company?
The symbol is RY and Rainier.
Oh,
Rainier.
sure. Okay. I was with Alex Brown when that deal came together, actually, so it's been a long time. Any other questions or comments, John?
No, I think I said that.
Okay. Thank you. Did anyone sign up for public comment? Okay.
Nope.
Having no one sign up, I'll hereby deem public comment.
IAC member question and answer. IAC member Q&A.
Yeah, go ahead and get to this.
Sorry.
I hereby deem the public comment section closed, and now we'll go around the horn. Jason's recommendations, see if any IAC board members have any comments.
Great job as always. Amazing what you guys put together every quarter for us, and look forward to seeing it again. Thank you.
I just echo that, and the information presented today was very insightful, I thought, and very well presented. Thank you.
I was glad to see the results of last year. I hope that this year will be just as good, but I doubt it.
Understandable.
You can't predict the unpredictable?
Guys, looking around the room today, I just appreciate the continuity, seeing the familiar faces and all we've done to keep great staff like you guys. It's not lost on us how fortunate we are to have you guys. So we appreciate your devotion and continuity, and keep it up.
But Jeff had to stick in here because when he came, the plan was 110% funded.
That's right.
Is there a correlation
There, yeah. We have aligned incentives there.
Right.
I will tell you, as a teaser for the next meeting, coming back, if you've been lucky enough to hear Mr. Clifton with Strategas is currently scheduled to join us for the next meeting. So we're hoping that stays on the calendar. That'll be very timely for what's going on this year.
Yes.
That'll be nice, but are we getting brisket that day also?
How about that?
All right. Some of you may not know, he's a world champion.
World, that's what's going on. We've been local a few times.
Yeah, said that for some other people who may be listening in. Any new staff members you want to recognize?
Yeah, we do have one new one. So Evan Prohaska, he started about a month ago. He's a investment analyst on the risk team. So
Good.
welcome.
Evan, thank you. It's not your mom's birthday, is it?
It is not.
Make sure you know when that is, by the way. All right. Before we close, we'll have a better look at who's going to sit in this seat next year, after next week.
Speaking of continuity, I intend to make sure that between next week and in November that we will, our door and our mind and our heart will be open to the two candidates who will be vying to be the next keeper of the public purse. The plan is after the election in November that I will meet with those the winner, the next treasurer in North Carolina, and open our heart and open our mind and open our door even more to provide them a way of coming in and meeting staff, because that's where the continuity comes from. I know that whether they say it or not, or whether it's written on their face or not, there's always uncertainty when you have an elected position and things change. But as I've said all across the state, with everything that's dividing our society these days, political party, gender, and race, none of that exists at the Treasurer's Office. We focus on the color green, GREEN. And it's been a pleasure chairing this board. I've made every meeting as the treasurer, and we're going to finish strong. So just want to let everybody know that. So I appreciate all the effort that all of you put into driving long distances and short distances. So lastly, I guess it's just the nature of what's going on. Probably saw the news yesterday where Sandy Gottesman's wife donated $1 billion so that people could go through med school and be debt free. And of course, since we met last, I guess Charlie Munger has passed away. Thank you for the book, Rhonda. And back in the day, a lot of these folks are passing on. And when I read this article, I never knew Sandy's wife, but I knew Sandy because Sandy was the legal advisor and the broker to Warren Buffett during my time when I was at Alex Brown. And there's a whole posse of those folks that ran together. A guy by the name of Jack Byrne, who you probably have never heard of. He ran a company called Fund American, which ended up becoming White River. If you go to Dartmouth, you'll see he and his wife dedicated the Student Center, which at that time was the single biggest gift that Dartmouth had ever gotten. And as a result of Warren Buffett calling Jack Byrne when he was asked to take over Geico, when the heir to Geico had jumped off the Y of the Hayes Adams Hotel in Washington, D.C. and committed suicide because he had taken all the Geico, all the family fortune and all the Geico portfolio and put it in the Nifty 50 and, lost 75% of the value. And I tell these stories because I'm not going to have any more opportunities to tell these stories. And it's ironic given my background that I even have these stories. They're all firsthand. And so Warren Buffett bought 33% of Geico from the margin clerk of the estate of the guy who committed suicide, who jumped off the Y of the Hayes Adams Hotel. And so he bought about a third of the Geico stock, and he called Jack Byrne, who has a really hot-tempered Scottish personality, and said, I'd like to come and talk to you about this company. And Jack Byrne hung up on Warren Buffett twice. One of my mentors at Alex Brown hung up on Warren Buffett twice when I was actually at the office next door. So finally, Warren Buffett gets Jack Byrne on the phone. He said, you don't understand. I own a third of this stock that you've now been asked to come in and take over and repair. And Jack Byrne said, if you knew what I knew about this company, you would not own a third of this stock because it is worthless. At that time, the stock was saying like $2 a share or something. And Jack says, and Warren says, listen, I'm coming to Washington, D.C. to visit with my friend Katharine Graham, who was at the Washington Post. And you've got to eat dinner sometime. So can we just grab a bite? So Jack Byrne agreed to meet Warren Buffett for dinner. So Jack and his wife went out to dinner with Warren Buffett. They went back to Jack's house, and they sat there from 9 o'clock p.m. to 6 o'clock the next morning talking about investments. And Jack said, I've got to take a shower. I got to go to work. So Warren Buffett leaves. Jack's wife is now getting up and fixing coffee and stuff. And Jack says, honey, I need you to sit down. There's something I need to tell you. Not normally a good way of starting a conversation in the morning. For any newlyweds in this audience, don't ever start your conversations that way. And Jack Byrne's wife says, well, what is it, honey? He said, and see, up to this point, Sandy Weil and Jack Byrne had been in this contest about who was going to take over Transamerica. Sandy Weil won and Jack lost. He said, I promised you as long as we were married, I would never take out a second mortgage on a house. And so I want to take out a $10,000 second mortgage on this house that we just bought. And she said, okay. And he said, and we've never had a new car. And when I got this job, I ordered us 2 new Cadillacs, and they were like $9,000 a piece or something like that. I'd like to call and cancel the order on these Cadillacs. She said, okay. And he said, so I want to take $41,000 and I want to buy 750 shares of this guy's stock that I've been talking to all night at $40 a share. This is not baby Berkshire. This is big Berkshire. And she said, okay. So that $40,000 investment, and after the stagflation of 74, that was the $22 million gift that went into giving the money to the Byrne Student Center, BYRNE, at Dartmouth University. So I knew Sandy, I knew Phil Fisher, these were not clients of Alex Brown. They were clients of mine, and which is strange because just a few years before that, I was a garbage collector in Winston-Salem. But I knew all these folks, and they're now passing away. And it's my way of telling everybody in this audience that it doesn't matter how handsome you are, or how pretty you are, or how smart you are, or how lucky you are in life, that you're standing on the shoulders of somebody else. And some of these people that I'm standing on the shoulders of, that I learned so much from, are passing on. And I think it's just a moment of reflection to think about who all of us are standing on the shoulders of today. Some of who are still with us, obviously, gratefully, and some that aren't. And because nobody ever gets anywhere in life by themselves. So I'm not going to close our meeting in honor of these folks, but I appreciate you giving me an opportunity to tell some of these stories, because the bow on that last story is that there was a $280 million anonymous gift made to a private college this year in North Carolina that also has that, whether it's the Byrne Center at Dartmouth or the donation that was just made in honor of med students, or the $280 million donation that was made to a private at Catawba College. It all came from one place. It all came from Berkshire Hathaway. So anyway, so with that, I'll entertain them in honor of your mother.
Yes.
How do you spell her first name?
Janie, 2 N's. I have a quick story. Her real name is Early
sure you want to say
Snow. Yes. Her real name is Early Snow, and she changed her name to Janie because she had a cousin named Janie, and she loved her cousin Janie so much. So Early Snow, also known as Janie Funderburg. That is my mother's name.
AKA with 2 N's.
Yes, 2 N's.
Got that, Mr. Secretary?
Early Snow.
We have a motion to adjourn. Motion to adjourn.
moved.
And a second.
Second.
Okay, motion to adjourn, second. Any further discussion? I want to thank all the staff and all those that presented here today and for making this jump up on the table, and we're adjourned.
Thank you.
Thank you. Very.